Okay, I think we could start now. Hello, and welcome to today's webinar hosted by Index One in collaboration with BX and FolioBeyond. I'm Gayatri from Index One, your host, joined by my co-moderator Steve Bitsker from BX. We're excited to introduce our speakers, Alexander Berg, founder and CEO of Index One, Chris McHeffey, president of BX, and Young Lim, CEO of FolioBeyond.
Glad you joined us today. Today's webinar will explore the benefits of the 60-40 strategy, discuss what the 40% could entail, and examine alternative blending strategies like a model we call 10-10-10. We'll use models such as FolioBeyond's Dynamic Volatility Fixed Income Index to help us rethink the strategy and outperform standard 60-40 benchmarks. FolioBeyond is a technology platform that enables efficient portfolio management through their institutional quality algorithms for portfolio construction, asset allocation, automatic rebalancing, and tax loss harvesting.
Thanks, Steve. Additionally, we'll demonstrate how Index One, a backtesting and index calculation platform, facilitates flexible 60-40 model construction, and how BX, a direct indexing platform offering diverse and open architecture models, promotes these diverse and high-performing models in direct indexing portfolios.
We'll have time for questions after the presentations, so please hold them until that time. Without further delay, let's get started. Chris, president at BX Partners, could you kick things off by explaining what an ideal 60-40 portfolio should look like, if such a thing exists?
Yeah, thanks, Steve. I don't know that there necessarily is an ideal 60-40 portfolio, but over the last couple of decades, we've come to associate a moderate risk profile with a 60-40 asset allocation. So since so many advisors kind of default to a 60-40 for their moderate clients, we decided to use that as the anchor for what it is that we're going to talk about. In terms of building an ideal 60-40 portfolio, I think that one of the first things that you want to make sure that you've got right is to use the best possible, ingredients, right? In other words, there's a lot of different things you could choose for your 60 and for your 40, but like for the 40, people default to the bond aggregate, whatever ETF you use as a proxy for the bond aggregate, that's kind of the default in an asset allocation. Well, your 3-year return on that is sharply negative, right? So that's unacceptable. So we've partnered with, world-class investment managers from around the world to create better strategies. So we're going to hear from Young a little bit later about the FolioBeyond dynamic volatility strategy, which has dramatically outperformed the aggregate and really helped clients, kind of meet their goals much better than what a default position kind of would have been. Moving to the equity side, we've got 12 different portfolio creators that we've chosen from around the world that are all outstanding at delivering certain types of investment strategies. And we've created a roster of 40 plus what we think are absolutely world-class investment strategies that are available on the BX Index platform. So they're not designed to simply be the S&P 500. They're designed to do different things in different markets for different reasons, all with the goal of creating better outcomes for clients. We're just looking at this morning. If you had a typical 60-40 portfolio, like 60% SPY, 40% AGG, your 3-year compounded return is less than 1%. That's not acceptable, right? That's not getting any clients to their goals, and that's why people are coming to us. So let me walk you through kind of our process on how we created our 60-40 model, which is in fact 60-40, even though I don't necessarily think that's the best asset allocation at all times. Back up a slide and I'll take you through the whole process. Right, so this is what we wanted to do, and these are the kinds of things that we take into consideration when we're building portfolios, when we work with advisors to do this. So you can see a Riskalyze score up there. A lot of advisors default to nitrogen as their risk management system. So we like to make available to you what it is we're getting at. So That 60-40, 60% SPY, 40% AGG is a 50. So the portfolio we created was a 51. Here are the things that we thought about when we created this blend. So we have 100 maximum total holdings was a constraint. You don't have to have any constraint there at all. Or you can say, no, I only want to hold 40 different items. We can work with you to create that. In this case, we took 100. I think a lot of you are aware that if you go to many direct index type shops and you want a small cap, a large cap, an international sleeve, you might own well over 1,000 securities, which we think is kind of ridiculous for a number of reasons. So we created these indices mostly with a much more compact number of holdings, 10, 25, 40, 50, a really manageable number of holdings so that you can create a portfolio that doesn't have 27 pages of holdings listed. And you don't have to do, for example, 200 trades to do your tax loss harvesting, right? So we wanted to do this by blending our strategies, by having superior risk-adjusted returns and similar risk to, a moderate benchmark. In this case, we chose the Russell 3000 and the aggregate, right? So we also, when we create these, these models, we look at the correlations between the strategies. That's really important. A lot of times we'll look at, a big box provider's model, and you pull up a correlation matrix and you're seeing nothing but 0.9s on all the equity sleeves. Well, that's not really any diversification at all, right? What we like to do is see 0.6s and 0.7s, because if you have strategies that perform well and you blend them with each other, and they have low correlation, your risk-adjusted return is going to benefit dramatically from that going forward. So what we also do is we leverage indexes from different creators. In other words, every thought process is different. So not only do you get the diversification benefit of the low correlation, but you have different thought processes that are creating your outcomes in the portfolio. So now we can roll to the to the next slide. Right. So this is how our 60-40 model is done. You can see a compound return of almost 14 versus 7 for that benchmark portfolio with a Sharpe ratio that's almost 50% higher, a Sortino ratio, which if you don't use Sortino ratios, it's actually the most important thing. It's, how much return are you getting per unit of downside risk? Oh, and we achieved this compound return of 600 basis points better with a maximum drawdown of 14 versus 21. That's something that's really important to your clients. In fact, the standard deviation is kind of meaningless to your clients. It's how much money do I lose when times get bad that's really important. So we think that this is a really well thought out portfolio that could substantially benefit a lot of clients. Turn this slide, please. So you can see what we have in here is 6 different indices that, we call our strategies indices for a number of reasons. You can call them strategies, you can call them whatever you'd like. So we blended the FolioBeyond dynamic volatility with a little bit of the Thor diversified bond. Once again, they don't correlate all that highly, which creates a better outcome. The dividend growth Titans 10, that is like, you can think of that as the 10 best aristocrats. Large cap momentum 10 that's 10 stocks from the mega cap universe that have the best momentum right now. The SMID momentum index to get you your small and mid cap exposure, and then the mega cap index, that's kind of your keep it in the fairway kind of play. And you put all these together to get that kind of outcome that we were talking about. Now, since the FolioBeyond dynamic volatility is so prominently featured in so many of our models, we wanted to get Young on to talk about what is the thought processes behind dynamic volatility and what's it going to do for you. So Young, why don't you take it from here?
Yeah, thanks, Chris. So I wanted to talk more about our fixed income model, how it's constructed. Before we do that, I want to provide a little bit of background on the fixed income markets in the current environment. As we all have experienced, fixed income markets have garnered much more attention recently, given higher yield levels and potential Fed easing, especially with yesterday's Fed announcement. It looks like, depending on economic numbers in the next couple of months, there will be an initial Fed cut. But regardless of the future series of Fed actions, if they occur, prudent investment management always requires proper risk diversification and risk management. So one of the aspects of the fixed income market that I want to highlight is the shape of the yield curve. When the Fed starts cutting rates, that certainly means short rates are coming down. But what does that mean for intermediate bond rates? What about longer term yields like 10-year and 30-year yields? And we also tend to forget that the yield curve historically has generally been positively sloped, meaning long rates are higher than short rates. We're sort of in a unique time period. In fact, we were setting a record for, at least over the past 20 years, it's been the longest time period when the yield curve has been inverted, and it is still inverted. And it's been about 2 years since the initial inversion occurred. So we're hitting a record there, and at some point, the curve is going to become more normally shaped. And all else being equal, that sort of makes sense because it's the classic term premium hypothesis, which means that as you invest in longer term instruments, volatility is higher, there's greater price risk. So you need to get compensated for that with higher yields. That's the essence of why the yield curve is positively sloped. So it's hard to have a perfect crystal ball, but as short rates fall, we'll have to keep in mind that longer rates may not decline as much. There might be scenarios where longer rates actually go up, and that all depends on the strength of economic numbers. Now, all of this is important when you're analyzing fixed income instruments because it's not just about going long or flat the fixed income market. There are obviously a lot of nuances. What kind of duration exposure do you want to take? At what point on the yield curve do you want to be positioned? What mix of credit risks do you want to be exposed to, and what sectors look attractive? So how do you capture all these dynamics within a rule-based framework? So what FolioBeyond has done, and we've been running this model since more than 5 years ago, is to capture all these dynamics using quantitative methods and understanding, first of all, fixed income markets are dominated by institutions. There are pension funds and insurance companies that have their own set of goals with regulatory constraints. What these types of investment actions by institutions result in is some market inefficiencies. So if you're a pure value-driven investor, you're going to find inefficiencies from time to time for various reasons. So in order to capture those inefficiencies, what you need is a repeatable process for understanding the inefficiencies and implementing trades based on where relative value is the most attractive. So our fixed income model is designed to capture all those effects. And the next slide shows some of the drivers of value. And if you can switch to the next slide. So first of all, value is defined by forward-looking income or yield. And believe it or not, some people still make the mistake of just looking at historical returns to ascertain value in fixed income. That can really get you in trouble. So in the fixed income markets, you have to look at forward-looking yields. And very importantly, you have to price out the embedded risks, options or default risks. So in mortgage-backed securities, you have to price out the prepayment option. In high-yield bonds, you have to price out the default risk. Once you do all of that, you're going to be able to compare different fixed income sectors on an apples-to-apples basis. Now, the next slide shows the risk side of the equation. You have to understand the volatility risk. You have to, as Chris mentioned earlier, understand correlation effects. It is extremely important in a portfolio context. And momentum effects tend to be present, not all the time, but the markets get overextended in both directions. So we have a two-factor model that captures momentum effects. And then implied volatility effects are often overlooked. And implied volatility is very important because current implied vol levels, as reflected in the options markets, capture what investors are perceiving the risk levels to be. A great example is during the onset of COVID, implied vols shot up. and at that time, if you were just focused on historical vol measures, you were way off the mark. But if you rebalance your portfolio based on implied vol levels, you had a better risk position on. So looking at the fixed income universe on the next slide, we look at the overall fixed income market based on duration exposure and product type. So from top to bottom, you have different duration instruments, starting with negative duration. MBS interest-only securities are one of the few instruments out there that actually provide negative duration, but current income at the same time. And then as you extend out in duration, you have various product types that are short, intermediate, long, and ultra long. And then across the top, you have different product types ranging from treasuries, corporates, munis, structured products. And so these are the ingredients of our fixed income model. The model captures the risk and return elements of all these sectors and optimizes the portfolio by targeting the volatility of the Bloomberg aggregate index. So when you do that optimization, you're maximizing yield and returns. You typically end up with 5 to 10 ETFs. And in order to capture the ongoing moves in the capital markets, we actually run the model daily, but rebalancing only occurs whenever the risk threshold deviates by 15%. So to summarize, we're generating higher income and total returns than a passive index. We're generating attractive security selection alpha. We have good downside protection, as shown the past few years when we've had one of the highest volatility in the fixed income markets. We were able to generate much better returns, and over the past year to date, we're outperforming the Bloomberg Ag by 400 basis points. We are outperforming the index by anywhere between 300 to 500 basis points over the past 1 to 3 years, and over the long run, it's been 200 to 500 basis points. And given that all the ingredients are ETFs, liquid ETFs, the rebalancing exercise is very straightforward. They're all liquid ETFs that trade actively, and it's a much better way of allocating to the fixed income market than trying to rebalance a portfolio of 1,000 CUSIP bonds. So I'll take a pause there, and then we can sort of discuss other aspects of this model later on.
So now we could pass it on to Alex, who will be able to give us some insight on how this model was built on the Index One platform.
Sure. So thanks, G, and thanks everyone for your words so far. Means our indexing platform, basically we support the creation, backtesting, and ongoing calculation of these ETF-based fixed income models, blended models, and equity-only models, and several other things that are, I think, out of scope for this webinar. While blended models are not new to the market, I think the environment right now is very interesting, as Young, I think, was saying that we have fairly high yields compared to historical averages or recent averages, and also high valuations in equities. So I think fixed income is looking far more interesting than it has previously, and especially for formerly equity-only investors. I think a fixed income component is looking a lot more pertinent to protect your downside, and also lower the cross correlation in your portfolio. So, on a personal level, at least as a sort of long-only equity investor, it's quite hard to ignore how much risk-adjusted return you can get even from a small fixed income component, as Young's model here is showing, and many other models out there. But yeah, more to what we do at Index One and how we construct these models. So our mission as a company really is to move indexing technology forward, and we basically provide the infrastructure for BX, FolioBeyond, and other providers to run and maintain and backtest different models, as well as publish them and distribute them to investors or folks who want to use them as benchmarks or direct indexing, ETF issuers, and so on. And with BX in particular, really the main, I think, benefit with our platform and what's been really interesting to see play out is, we've been able to centralize, so run sort of the calculation of models from a lot of different providers in the same place, and have the ability to blend these together and find sort of optimal combinations of models. The way our system works in practice, and how we, for example, set up the model on screen here is relatively straightforward. It's what we call a basket calculation. So Young and his team is doing the research and obviously owns the model and creates the weights or baskets, and we react to those rebalances as they come along and update the model accordingly. And on an ongoing basis, we run things like co-production adjustments. For this type of model in particular, it's mainly around handling distributions, so timing the reinvestment of distributions, tracking upcoming distributions, calculating the real-time and end-of-day price of the index, and distributing it to various users. Other ways we build models is also through a sort of systematic strategy. So we have a tool that allows for basically setting up the rules behind a strategy. So it can be anything from universe selection criteria to weighting criteria, to rebalancing either on a scheduled basis or in reaction to market events. And I think this is what's really interesting, especially going forward, is how we can make sort of what has traditionally been very passive to look more sort of active and systematic in nature. And I think, in the future we'll see a lot of blended models, but also fixed income only or equity only models that are more reactive, more active, and hopefully also provide better returns than the traditional passive indices that I think are mostly used in the market right now. But yeah, that's I think overall. I think I'll hand it over back to G to.
Thanks, Alex. So I'll pass it on now to Chris. Chris, could you tell us what the 10-10-10 model is and what that entails?
Yeah, I'd be happy to, G. But first, let me go back through something that I meant to mention in my previous remarks, which is that, Steve said, what's the ideal 60-40 portfolio? And we talked a little bit about whether that's really the appropriate asset allocation. But by following our thought process a little further and finding these strategies that really have lower correlations with each other or lower downside than the market, all of a sudden you're in a position where if the client was moderate and prepared to take a 20% maximum downside and the model we're showing you that 60/40 only has 14%, you might want to change that 60/40 to 65/35 or 70/30 and get your maximum downside back into the right place, but give yourself the potential to have more upside going forward and maybe start to fill in some of the hole that was created by you being 60% SPY, 40% AGG for the last 3 years and making exactly zero, right? So, you can get creative when you do these things. Now, the 10-10-10 model that G referenced is something that we put together that appeals to a lot of advisors because it's a diversified portfolio, but there's only 30 total holdings, right? And the 30 holdings are, it's that Dividend Titans 10 strategy, which is, like I said, it's like the top 10 aristocrats. It's the top 10 US mega cap momentum strategy. So that tends to be a growth allocation. So you've got US growth, US value, and then a top 10 international holdings. And these are all US listed international companies, whether they're ADRs or primary listings is irrelevant, but they're all non-US companies. So what you've got is a globally diversified portfolio with this 10-10-10 and only 30 names in the portfolio. So it's extremely manageable. Now, what makes it interesting is, once again, you've got these different thought processes going on, different things happening in different markets. So over the 7-year horizon that we can evaluate this, the ACWI, that's ACWI, that's basically the entire global equity index, is how a lot of people default to that. There's an ETF under the ticker symbol ACWI. So over that 7 years, the ACWI has returned 9 and change %, whereas this 10-10-10 portfolio is 18 and change. So not quite double, but basically just about double the return of the ACWI with, as you would anticipate, Sharpe ratios and Sortino ratios that are dramatically higher. So what we did is we took that 3/10s model and blended it with a 40% fixed income sleeve to get, because the title of this presentation was 60/40, to show you how you could do on a 60/40 doing it this way. So you wind up in a position where your total return is well more than double that of the global moderate benchmark, which is 60% ACWI, 40% AGG, right? So if I can give you a portfolio that's got double the return and about the same standard deviation and downside, look at that. I'm doubling my Sharpe and Sortino ratios almost. And that, those are the metrics that you look at for risk-adjusted returns. So we can work with you to create what it is that you want, but this one's really intuitively appealing. And frankly, your total holdings would be like 10 fixed income ETFs and 30 stocks, and you've got a globally diversified portfolio that contains both equity and fixed income exposure. So really, a really strong performer, but also very manageable and easy to kind of digest what's going on. So that's kind of our 10-10-10 is what we've kind of dubbed the strategy, blended with fixed income. So that's what, that's pretty much what I've got on that, G.
Thank you so much, Chris, and thank you all for your insightful contributions on fixed income, 60/40, and the 10-10-10 models. We will now open the floor for questions. To our audience watching, please feel free to submit your questions in the comment box below. We've got 4 questions at the minute. I'll start off with Connor's question. Thank you, Connor, for your question. What is the advantage of utilizing Index 1 versus a legacy provider? Alex, do you want to take that?
Sure. That sounds like a planted question, but I think it isn't. But happy to answer that. We obviously see ourselves as a very solid provider for especially newer types of index use cases. What legacy providers, I think, do have a very robust offering, and obviously a track record of providing indices to the investment industry for decades now. And but there are some I think challenges with using legacy providers that we're trying to tackle with our business. One is sort of the flexibility So we have a kind of user-facing platform that's very intuitive to use, and our clients and partners can sort of self-construct and manage indices on their own accord. It minimizes back and forth between the user of the index or the index creator and the platform provider or calculation agent, which is us, and makes things a lot smoother. And especially as it comes to developing an index, things like running back tests iteratively and very quickly on our tool is something our clients and partners find quite intuitive and useful. I mean, the other point I would make is around use of technology. So we see ourselves as a very tech-oriented provider. So everything we've built is API-based, so it can be easily integrated to other solutions. We can set up rules-based delivery of index data, weights, values, rules-based rebalances as well, which I think is a very key component to managing indices in a more automated and scalable way. And the final point I would make, and I think it's kind of as an extension of how much we focus on automation, is also cost. So, the actual dollar cost of creating an index can be very low when you're using sort of a more automated SaaS type of tool that we have, but also the implicit cost of time invested is a lot lower when using kind of the right technology. But I think that's basically the gist of it from my point of view.
Yeah, I'm going to chime in a little bit on that one, just because as Alex's best customer, I just want to second some of the things that he said. Their technology is fantastic. The cost is very reasonable, and they're very flexible. They've been able to partner with us to deliver solutions to various platforms in ways that have, they use their technology to make some of these integrations seamless. They could have been extremely painful, and they've been a delightful partner to work with. So I just wanted to say that as somebody that uses the platform extensively.
Thanks, Chris. That's really nice to hear.
Thank you, Alex and Chris, for that. So we've got a few more questions here. So we've got George with, how do I determine how much RISR to use, and how do I start using the FolioBeyond dynamic FI model?
I'm going to let Young take that one.
Okay.
So by using BX index, you automatically get exposure to our fixed income model. So whenever our fixed income model updates the allocations, it'll flow through to BX index through index one, and whichever custodian you're using, the updates will happen. So in terms of the different components of our fixed income model, the different components will be updated whenever there's rebalancing, and the investors would be able to tell what the overall allocations are to each of the underlying ETF.
Thank you, Young. And we've got a couple questions from Chris.
Not me.
Are the 10, not you, it's a different Chris. Are the 10-10-10 equally weighted, and is there a rebalance schedule for the 10-10-10?
Yeah, so I'll take that. So the 10-10-10, actually that question could mean two different things. One, the component holdings of the three different indexes are not equally weighted. They're weighted according to a slightly different methodology, but the basket itself is 33 1/3%, or I think we said 33, 33, 34 for the three different sleeves. Because as it turns out, that's an equal split between what you can think of as growth and what you can think of as value. and international ex-US, and a 33%. That's not far from the weighting in the ACWI. So that a third was simple but elegant in that scheme. And then each of the component holdings, or each of the component indices within the 10-10-10 are rebalanced quarterly, as is the strategy, the overall strategy itself. So it's a quarterly rebalance.
Okay, brilliant. Well, thank you for your
sorry if I can interject, just as a follow-up to my response on using the FolioBeyond index. Can one of you sort of describe how the integration works, for users, whether you're on Schwab or another custodian? What does the integration process look like?
Could you be a little more specific with that, Young?
Like, how would an RIA access, let's say, the FolioBeyond fixed income model, the index?
There's a large number of different ways that an advisor could access this, from direct delivery to, we have a number of partners that have integrations with the various custodians, et cetera. So, Alphathena, Artha, Advisor Stack, Syntax indices. There's a number of different ways that these products are accessible to advisors, and even the connectivity to their end custodian. We can talk about what the most optimal way they're trying to get done and who their custodian is.
Right. So depending on how the RIA is set up, I guess they would coordinate with you on the best way of implementing the exposure to a customized index.
Correct.
Okay.
Another question, Steve, here with BX Partners. And I guess this would be good for you, Chris. But Young, I also welcome your thoughts. What if an advisor wants 100% equity or 75-25? What do you suggest or advise in those instances?
Absolutely. We have the highest quality kind of ingredients. So whatever the appropriate asset allocation for what you're trying to accomplish with any specific client is, that can be done. So you can go 100% equity, you can go 25-75 or 75-25, whatever the appropriate blend is, and we can partner with you as kind of a co-pilot to test out what the ideal blend of the strategies that you want to embrace. Is. We actually, we enjoy working with advisors to help them create what it is they're trying to get done. For example, even clients who do want a balanced portfolio in a taxable environment with a high income client, all of our fixed income models are taxable. Okay, so we can build you a 100% equity model that you love, and then continue doing your muni bonds, on your own. However it is you want to do it, we can help you to get where you need to go.
Right. Thanks, Chris. We actually have a follow-up question from Chris, who asked the question earlier about the 10-10-10 model. He just clarified that it was the question had more to do with membership weighting allocation at the stock level driven. What's that driven by at the stock level?
That's actually some pretty complicated proprietary math that's beyond the scope of this call.
Okay, sure. We could take that offline then with the question. So I think that really wraps up the questions, G, unless you have some.
Yeah, so one of the questions is, what's the best way to rebalance a 60-40 index?
I think you're going to want to look at the individual component indices that make up your diversified model and try and figure out what the best rebalancing regime is. Some of it is, at a certain point, you're not going to get that different of an outcome rebalancing quarterly versus semi-annually, but it is going to be some sort of a difference. So it's really, what is the advisor comfortable with? And we tend to create, like, our supermarket shelf models tend to be quarterly rebalanced because that tends to be the cadence at which people prefer. But you can easily create models to rebalance monthly or even annually. It's really up to you.
Okay, brilliant.
And to
Thank you.
add, maybe if I can add to that, so I guess another set of parameters you can look at when you're rebalancing is how much are the allocations changing. So if the allocations change a lot, obviously that would be a good time to rebalance. So, but if the allocations are just minimal differences, then you can skip a rebalancing. So with our fixed income model, it's all driven by thresholds and how much the risk levels change. I guess you can sort of apply some of that approach to the 60/40 model based on how much whether a rebalancing is warranted, and it doesn't necessarily have to be a quarterly or monthly time period. But I guess at a minimum, doing a full rebalancing maybe every 6 months or even every quarter might make sense.
Right. But yes, when we do rebalance these portfolios, we go back to our base asset allocation, whether it was 70/30 or 60/40 or 80/20 or whatever it was. We're taking, on those rebalance dates and putting it back into line. And it becomes kind of important to do that from a risk control perspective on a somewhat regular basis, simply because if you have environments where equities are up 30% and bonds are down 10, your asset allocation is kind of out of whack at that point. And if you're managing to a risk budget, you might not be on that budget anymore. So it's important to get back to, home base, so to speak.
Brilliant. I think those are all the questions that we have for now. Thank you everyone for sending in your questions. If you'd like to contact any of today's speakers, you can reach Alex at www.index1.io, Chris at www.bxindex.com, and Young at www.FolioBeyond.com. Thank you all once again for your time and participation. We hope this webinar has inspired you to explore 60/40 and other fixed income models. You can find FolioBeyond's model and other models on the Index One and BX website. Thank you all again, and we look forward to seeing you at our next webinar. Thanks, everyone.
Thank you.
Thanks all.
Got it.
Thanks.